Welcome back to Mastering MHA MBA. This is Chapter 12, Part 3 of 3. We built the master budget as a set of numbers. Now we confront a harder truth. The moment those numbers become targets that people are measured against, they start changing human behavior. This part is about responsibility accounting, the games people play with budgets, and how to design a budget that motivates instead of distorts. Here is the central idea of Part 3. A budget target is never neutral. The instant you tell a manager they will be judged against a number, they begin managing toward that number, and not always in the ways you hoped. People manage to the measure. A technically perfect budget can still drive terrible behavior if it is designed carelessly. So the accountant's job is not just to get the math right, it is to understand the incentives the budget creates and to shape them deliberately. Responsibility accounting is the system that makes budgets personal. It organizes the company into units, then traces revenues and costs to the specific manager responsible for them. Each manager gets a report on the part of the business they actually control. This is what lets the company evaluate performance fairly, by comparing each unit's actual results to its own budget. Without responsibility accounting, a budget is just a company-wide number that no individual feels accountable for. With it, the plan has an owner at every level. Responsibility units come in four flavors depending on what the manager controls. A cost center, like a manufacturing department, is judged on managing costs. A revenue center, like a sales region, is judged on generating sales. A profit center, like a product line, is responsible for both revenues and costs, so it is judged on profit. And an investment center, like a whole division, is responsible for profit relative to the assets invested to earn it. The type of center determines what you hold the manager accountable for, and that should match what they can actually influence. That leads to the controllability principle. A manager should be held accountable only for the things they can actually control. It sounds obvious, but it is surprisingly hard to apply because almost no cost is 100% controllable by a single person. A plant manager controls labor scheduling but not the global price of steel. So in practice, controllability is a matter of degree, not a clean line. The practical guidance is to focus reports on the costs and revenues a manager most strongly influences and to use judgment about the rest rather than punishing people for things beyond their reach. Now, the most common game of all, budgetary slack. When managers help set their own targets and are rewarded for beating them, they have every incentive to make those targets easy. They quietly understate the revenue they could earn and overstate the costs they will need. That cushion is the slack. It guarantees they look good at year end, but it also means the company is planning around deliberately soft numbers. Slack is the natural and predictable result of tying rewards to a budget the manager helped write. One counter move to slack is the stretch target, a goal set deliberately higher than comfortable to push people to perform. Used well, stretch targets can lift effort and unlock performance nobody thought possible. But there is a knife edge here. Set the target slightly beyond reach and it energizes. Set it wildly beyond reach and people give up, or worse, start cutting corners and manipulating numbers to fake it. The skill is calibration, ambitious enough to motivate, realistic enough to stay believable. A more structured approach comes from Japanese manufacturing. Kaizen budgeting. Kaizen means continuous improvement, and a Kaizen budget builds expected improvements directly into the targets. Instead of assuming next quarter's costs match this quarter's, it assumes they will be a little lower because the team is expected to keep finding efficiencies. The budgeted cost per unit ratchets down period by period. It bakes a culture of relentless improvement into the numbers themselves, so standing still counts as falling behind. Budgetary slack and gaming are as old as budgets themselves. What is new is how modern tools are changing the dynamics, making padding harder to hide and discipline easier to enforce. Two updates. Recall zero-based budgeting from part 1. Look at it now through the lens of behavior. Incremental budgeting quietly carries last year's slack forward forever because nobody re-examines the padded lines. Zero-based budgeting blows that up by forcing managers to justify every dollar from scratch each cycle. The padding has nowhere to hide. That is a big part of why the cost pressure since 2022 revived it. Companies were not just chasing savings, they were using zero based budgeting as a direct weapon against the budgetary slack that had accumulated for years. The second update is about continuous planning, now used by roughly half of companies. When budgets were set once a year and reviewed once a year, slack could sit undetected for 12 months. With rolling forecasts and frequent comparisons of actuals to plan, a padded target gets exposed quickly because reality keeps catching up to it in real time. Faster feedback tightens accountability. The flip side managers should watch for. Constant measurement can also push people toward short term gaming, so the behavioral care we have discussed matters more, not less, in a real time world. That completes chapter 12. You can build a master budget in order from the sales forecast down to the cash budget, and you understand that budgeting is moving toward continuous AI assisted planning. Just as important, you know that a budget is a human instrument. Responsibility accounting assigns ownership, and concepts like Slack, stretch targets, and Kaizen show how targets shape behavior. A great budget gets both halves right, the math and the motivation. We have planned the year, but reality never matches the plan exactly. So the next chapter tackles the other half of the budgeting cycle, what to do when the actual numbers come in and they differ from the budget. We will learn to turn those gaps into insight using flexible budgets and variance analysis. It is where budgeting becomes control. Thanks for watching, and I will see you in chapter 13.